The screens light up. Numbers blink. Bitcoin's hovering near 76,000. Not 80, not 85, yet. And everyone's asking the same thing. Can it get there? Here's the kicker. Markets don't panic at bad headlines. They don't shiver when inflation pops or when Ethereum dips a few percent in a day. They react to what most people aren't noticing. That sideways pullback, the small cluster of reversals, subtle, almost invisible if you're scrolling past charts, those are the signals that really matter. You've seen rallies die suddenly, right? Not because the news changed, but because the structure of the market quietly shifted under the surface. One day it's bullish, the next, a higher low is broken, and suddenly, the path to 85,000 is blocked. Right now, Bitcoin isn't screaming. It isn't panicking. It's grinding, tracing out a pattern that most people will miss. That pattern is the heartbeat of the market. You watch it carefully, and it tells you more than any headline ever will. Miss it, and you're reacting instead of anticipating. So today, forget the hype. Forget the news of the day. The real question is, what's the market whispering that nobody else hears? If you like this tone and pacing, I can move on to the next section. What just happened? The facts. And crafted in the same crisp, human-focused, neutral style. Bitcoin opened the week near 72,500. By midweek, it ticked up to 76,000. The move wasn't a straight line. Candles staggered, retraced, hovered. You could see the higher lows forming quietly, one after the other. Each pullback stopped short of previous lows. Ethereum followed a similar rhythm. After breaking above 2,300, it tested the 2,400 zone, then slipped back to 2,350, and then climbed again. Solana moved from roughly 88 to 92 over a couple of days. XRP traced a path from 1.55 to 1.62. Across the board, the moves were gradual, almost measured. Volume patterns show spikes at key intraday points, pullbacks, rejections, small bursts of activity during the bounce. Open interest in Bitcoin futures ticked up slightly, particularly on the longer-dated contracts. Nothing extreme, no violent shifts. Treasury yields edged higher by a few basis points over the same period, while the US dollar index, DXY, hovered near its recent average. Comparing to last month, Bitcoin is roughly 14% higher than its mid-January floor near 63,000. ETH is up 12%, Solana around 10%, XRP 8%. The pace isn't frantic. It's a grind upward, punctuated by brief consolidations. No major external news moved markets drastically this week. No regulatory announcements, no sudden exchange failures, no macro shocks. Price movement is largely chart-driven, technical levels dictating entry and exit points. In short, Bitcoin, Ethereum, Solana, and XRP all climbed modestly. Trend lines held. Higher lows confirmed. Parallel resistance zones capped spikes temporarily. Volume stayed within normal ranges. Market structure remains intact. Everything we see is verifiable. Candle patterns, pivots, trend lines, support, resistance levels, volume numbers, open interest. No speculation, no emotions. Just the data, what the market did, when it did it, and how fast it moved. If this reads well, I can now move on to the next section. Why it matters, cause and effect, where we start connecting these facts to practical implications and market dynamics. Those higher lows, the slow grind upward, they aren't just numbers on a screen. They set off a chain of consequences. When Bitcoin holds its support around 68,000 and then nudges towards 76,000, it influences market psychology first. Traders see the support holding. Confidence ticks upward. Small positions get added. Stop losses tighten. That's the first order effect. Increased buying pressure and slightly more predictable trading patterns. Next, derivative markets feel it. Futures, options, and leveraged positions respond. Open interest rises on the bullish side because the trend appears stable. When Solana climbs gradually from 88 to 92, It isn't just a price increase. Fund managers reviewing crypto exposure notice the momentum. Some rebalance portfolios. Risk models adjust. That's the second order effect. Capital flows subtly shifting across crypto and adjacent assets, influencing liquidity. Ethereum's resistance near 2,400 matters for a different reason. Large holders and market makers use that level to set hedge positions. If ETH struggles to pierce it, they may shift to shorts or protective strategies elsewhere. XRP, moving from 1.55 to 1.6, triggers a smaller but similar ripple. Exchanges see higher trade volume, liquidity changes, and price clusters forming at predictable nodes. It's also about timing. Bitcoin's slow rise gives algorithms, institutional traders, and smart money the chance to incrementally adjust exposure without shocking the market. This reduces volatility compared to sudden spikes. At the same time, the higher-low pattern signals to technically oriented traders that the market remains structured. They act accordingly, placing new entries just above prior lows, tightening spreads, and reducing slippage risk. Finally, macro linkages respond quietly. The US dollar index remaining stable, Treasury yields nudging slightly higher. These factors influence crypto's cost of capital, borrowing rates for leveraged trades, and the relative appeal of crypto versus traditional assets. Even a few basis points shift liquidity subtly across exchanges, affecting funding rates and swap spreads. All of these effects accumulate. The market doesn't move in isolation. A higher low here, a small resistance test there. They compound into observable behavior patterns. Prices, flows, and risk exposures adjust. Traders who understand the sequence anticipate not just the immediate move, but the knock-on effects across derivative instruments, altcoins, and correlated traditional markets. So when you watch Bitcoin grind from 72,000 to 76,000, you aren't just tracking a number. You're seeing the interplay of confidence, capital allocation, derivative positioning, and macro stability. Each candle, each pivot, each trend line is a small instruction for the market at large. If this style works for you, we can move next to historical context, similar, not the same, where we'll add perspective without letting history dictate predictions. The market has traced this kind of path before, but never in exactly the same conditions. Early 2021 comes to mind. Bitcoin moved from the low 30s to mid 40s in a slow grind, punctuated by brief pullbacks, while Ethereum and several altcoins followed in parallel. Traders at the time noticed higher lows forming in the short term, similar to what we see now. Yet there are differences. Last time, institutional adoption news, large-scale corporate purchases, was the primary driver. This time, headlines are quieter. Price moves are more technically driven than sentiment-driven. That subtle difference matters. When the catalyst is internal to the market, the behavior is steadier, more predictable. When it's external, even a small headline can trigger outsized moves. Take parallel trend lines, for example. We've seen them work before to guide price into predictable zones. In 2021, a series of higher highs and higher lows gave the illusion of momentum that lasted weeks. But once a key trend line broke, the market snapped sharply downward. Today, the trend lines are tighter. Support is more defined, and volumes are distributed differently. It's the same structural idea, but the context, the surrounding market, liquidity levels, derivatives exposure, is different. History also reminds us that micro patterns can diverge from macro outcomes. Back then, Bitcoin could surge in a week, but the macro environment, macro liquidity, treasury yields, US dollar strength still determined the next larger move. In other words, short-term bullish patterns didn't guarantee a sustained rally. They only indicated the market's immediate behavior. Finally, consider altcoins. Solana, Ethereum, and XRP have had past cycles where they mirrored Bitcoin's trajectory closely, only to decouple when macro or regulatory factors intervened. Today, altcoins show similar higher-low formations, but the timing and correlation may not perfectly match BTC. The takeaway is subtle but crucial. Historical patterns provide perspective, not prophecy. They filter emotion and prevent overreacting to every price spike or pullback. Recognizing similarities helps interpret the present, but differences remind us that the market is always evolving. Patterns repeat imperfectly. Context is everything. If this reads well, we can now move on to scenarios, probabilistic thinking, where we break things into bull, base, and bear cases while keeping conditional, risk-aware language. Bull case: what must happen for strength to continue? If Bitcoin continues to hold the 68,000 trend line and maintains the higher low structure, the market could grind toward 80,000. Ethereum and Solana would need to respect their short-term support levels, ETH near 2,350, SOL near 90, while XRP holds above 1.60. Liquidity must remain steady. Funding rates in futures should avoid extreme spikes that force unwinds. Any small pullbacks need to find support quickly, signaling confidence rather than panic. Positive alignment in macro indicators helps too. A stable US dollar index, moderate treasury yields, and subdued volatility in equity markets all reduce external pressure on crypto. If these conditions line up, the short-term bullish patterns extend. Breakouts over local resistance zones: Bitcoin above 78,000, ETH above 2,400, Solana near 100, XRP near 1.70, could generate momentum as algorithms and professional traders reinforce the trend. In this scenario, upside is likely incremental but measurable, continuing the grind rather than a sudden surge. Base case: most likely path if conditions stabilize. If trend lines hold but momentum slows, expect gradual sideways movement. Bitcoin may oscillate between 68,000 and 76,000. ETH, SOL, and XRP could similarly trade in defined ranges, bouncing off support and testing resistance. Open interest will fluctuate but not spike dramatically. Volume patterns remain consistent with the last 2 weeks. Spikes on retracements, quieter consolidation periods in between. Macro conditions, DXY, Treasury yields, inflation indicators remain largely unchanged, providing a neutral backdrop. In this scenario, gains are modest and measured. Traders can capture short-term swings, but must respect stops, because the absence of strong catalysts makes sudden breakouts unlikely. Pattern integrity matters. A break below any trend line could pivot sentiment swiftly. Here, the market consolidates, signals accumulate, and positioning sets the stage for the next directional move. Bear case: what could change the trend? Decisively. If Bitcoin breaks below 68,000 decisively, the higher-low structure collapses. ETH could drop below 2,350, Solana under 90, XRP under 1.60. In this case, stop-loss triggers, forced liquidations, and rapid capital rotation could accelerate downside. Macro shifts amplify the effect. A sudden spike in treasury yields, dollar strength, or equity market stress would tighten liquidity and pressure leveraged positions. Algorithmic trading could accelerate the decline, hitting technical stops sequentially. Even in altcoins, correlations may tighten, magnifying losses across the board. Positions held without proper stops risk significant drawdowns. Risk management here is key. Recognizing structural breaks early allows for strategic exits rather than reactive panic. Conditional summary: bull. Trend lines intact, resistance pierced, momentum builds leads to gradual continuation toward 80 to 85,000. Base. Sideways grind. Trend lines intact. Macro stable leads to consolidation. Measured moves, low volatility. Bear. Trend lines break. Macro shifts. Stop cascades leads to accelerated downside. Market structure compromised. In all scenarios, nothing is guaranteed. The probabilities shift daily with every candle, every pivot, and every macro data point. Risk management, stop discipline, and observation remain central. If this works, the next section is What I'm Watching, Key Indicators, where we dive into the specific metrics and market signals guiding decision-making. First, the US dollar index, DXY. It's subtle, but it matters. When DXY drifts higher, Bitcoin and altcoins tend to feel the pressure. Not always immediate, but steadily. A small uptick in the dollar tightens global liquidity and nudges traders to adjust positions. Watch the 90 to 91 zone. Hold there, and crypto keeps breathing. Break above, and the market's cautious. Next, Treasury yields. Short term, the 2-year and 10-year rates move markets quietly. Yesterday, yields ticked up a few basis points. That doesn't make headlines, but for leveraged positions, it changes funding costs. Crypto isn't isolated. If borrowing costs rise, short-term momentum can stall, even with bullish patterns intact. Volume and liquidity are constantly under my eye. A price spike without supportive volume is a warning. Look at Bitcoin's recent pullback and bounce. It's backed by normal intraday volume. That tells me the market is structured, not speculative panic. For ETH and SOL, similar logic applies. Low volume spikes hint at weaker conviction, making breakouts less reliable. Open interest and positioning in futures and options tell another story. Rising open interest on the long side can reinforce bullish bias, but if funding rates invert, leverage can unwind quickly. I track which contracts are being held, where stops cluster, and how derivatives exposure interacts with spot trading. Finally, inflation metrics, CPI and PCE, while indirect, influence risk sentiment. A sudden surprise can trigger rotations, even if technically the charts look clean. Traders react to macro numbers quickly. Every CPI print, every PCE update is a small shock to the broader financial ecosystem. By watching these indicators together, you see the invisible forces behind price movements. It's not about headlines, tweets, or speculation. It's the interaction of macro, liquidity, derivatives, and volume patterns that creates the path. Every candle, every pivot, every spike in open interest is a clue. These are the levers I monitor daily, not for hype, not for prediction, but to understand where pressure builds, where stops lie, and how short-term moves fit into the broader structure. The market whispers. Indicators help you hear it clearly. Step back. Take a breath. Bitcoin, Ethereum, Solana, XRP, they're moving. Candles forming. Trends testing. Nothing is screaming panic. Nothing is guaranteeing gains. The structure is intact, but conditions can change in a heartbeat. Patience is the real edge. Following trend lines, respecting support, managing stops, these aren't glamorous. They're essential. Every move is a signal, every pivot a lesson. Don't chase, don't guess, don't react emotionally. Let the market show you the path. Remember, this isn't investment advice. It's simply how I'm reading the market right now. Observe the data, respect the structure, protect capital, ride short-term opportunities when they align with disciplined rules, and always keep an eye on the bigger picture, the macro forces, liquidity, and the subtle patterns most people overlook. Markets reward those who watch carefully, manage risk, and act patiently. Stay disciplined, stay grounded. The next move will become clear, one candle at a time.